Good morning, everyone, and welcome to Weekly Profit Talk. Under normal circumstances, we do this every Wednesday morning at 8:30 a.m. Mountain Time. Had a little bit of a technical glitch this morning, so apologize for being a little bit late. Thanks for joining us. This week's topic is how to stay IRS compliant, what every doctor needs to know. And we thought this was timely because in just a few short days, as a matter of fact, next Monday, the 17th, the business tax returns are due. That is, if you are in either a partnership or an S corporation, the due date for your tax returns is a full month prior to the April 15th deadline. So that's coming up next Monday. And this is a subject that's got some topical interest, certainly to people that are attempting to make as much money from their practice as possible and keep as much of it as possible out of the greedy clutches of Congress and the Internal Revenue Service. So let's go ahead and we're going to share some visual aids here. Now, first things first, and this is super important. Taxes are not something that you go and do like a dentist appointment once a year. It's not a root canal. So the thing is you can make it quite a bit less painless, quite a bit less painful, excuse me. Mixing my adjectives there, beg your pardon. So we can make it quite a bit less painful by simply addressing the fact that you're going to owe tax. You're certainly going to have more than $1,000 in tax from your practice. It doesn't take much to actually accumulate that, say 20, 30,000 a year, and you spent many years in education, training, residency, to basically emerge into the world as a full-fledged professional. And you've got student loans to pay. You certainly are going to be making more money than that. So the good news is that unlike a wage earner, you only have to address this 4 times a year. It's a quarterly. And the quarters are a little bit offset just to make it confusing and also to obfuscate the whole thing and make it more difficult for people. The quarters end in April, June, September, and the end of the year. So that means that the second quarter is only 2 months long and the final quarter is 4 months. But that final quarter, fortunately, is also basically includes the entire end of the year. You have until January 15th of the following year to make your fourth and final estimated tax payment. And you want to make all 4 of these, even the one that's due tax season, which is April 15th, because this is basically the entrepreneur's withholding. Proper estimation of your income and the resulting tax liability of each quarter is probably one of the most crucial aspects of IRS compliance. Why do it? I think there's 2 big reasons. The compliance piece is simply because it actually is a rule. They don't stand over you with a bullwhip and they don't come to your house with handcuffs. What they do is they hit you in the wallet. When you file your tax return at this time of year and you haven't been making estimated tax payments, you're going to find there's a box next to amount owed at the bottom of your second page of your 1040, and it's going to have an additional amount. There's going to be some hundreds or even over $1,000 sitting there. Don't pay them $1 more than you absolutely have to. IRS compliance starts with making good estimated tax payments. And to do that, you estimate your income for the entire year based on the period, figure the tax on that, and then just divide back and make sure you subtract the previous estimated payments that you made. It sounds simple. There is quite a bit more that we put into it to help people, but that's basically it. Now, another thing about IRS compliance, you are basically reporting your income minus all of your ordinary and necessary expenses. And now I've put that in bold. This is important. And this is to your benefit because there may be, in fact, some expenses that you feel kind of morally questionable about. Sorry, rough speaking morning here. So here's the thing. If you do, in fact, need to spend money on a specific purpose, and the object of that is to increase your gross revenue or to make money by any means necessary, within the legitimate practices of your business, then um, that is going to more often than not be a legitimate write-off of your business. One of the things I can think of is there is education outside of the continuing ed that you have to take, and I've got that too. But you may, in fact, find yourself looking into getting educated on being a better business person or perhaps business coaching. These things are legitimate business expenses, and they are, for my mind, they pass through the filter of ordinary and necessary. So make sure that you're writing off things that are actually related to making more money in your business. It's very important. And finally, sorry, here we go. This is a big thing, and I see this quite a bit. Maybe not so much with medical practices, but I have in the past, and we've been doing this for some years. You'll find when you take on a new, well, I'm sorry, let me rephrase that. I will find as an accountant, sometimes I will take on a new client and I take a look at their credit cards and the stuff going out, and they're shopping for clothes and they're buying restaurant meals that don't have a business purpose, and any one of a number of other things, going to amusement parks, that kind of thing. And the business credit card is just the one that's in the wallet, it happens to be handy. It's pump the brakes, stop doing that right now. Very simple thing that I can help folks with. And perhaps you're already doing this, but if you're not, hopefully this is going to be helpful information for you, because there is nothing that screams amateur louder than having a set of books where you have all kinds of distribution draws for personal expenses out of it. Simply do this. You should have a separate checking account and credit cards for your business anyway. Here's a thing that you can do. Nobody sees this but you anyway. Take a Sharpie out and actually write PER or BUS on your credit cards. Segregate them and make sure that you're only spending business forms of payment on business expenses. As simple and as logical and as no does this sounds, you'll be amazed how much personal spending I see out of business. And it's sloppy. It doesn't look good. So now you are entitled to the money that you make. Absolutely. And even if you are a S corporation officer and you're taking a wage out of your business, you still have net income left over and you're paying tax on that income. And if you want to spend it, you have a right to. Withdraw it in chunks and do it in such a way that it's easy to track. My suggestion is just whole hundreds amounts. Like, let's say, for example, you want to move some money from your business to your personal account, 500 at a time, 1,000 at a time, 2,000 at a time, but something that ends with a couple of zeros. So you're able to say, oh yeah, that was me making a distribution. Make your distributions in cash only, in whole hundreds amounts, and then do your personal spending out of your personal forms of payment. Simple, but effective, and it's very important. So hopefully these 3 tips were helpful to you. We like sharing these things once a week with you on Weekly Profit Talk. We do this every single week, 8:30 a.m. Mountain Time. That is 7:30 on the West Coast and 10:30 on the East Coast. So until next week, we will see you again. Oh, that just happens to be St. Patrick's Day too. No, it isn't. I'm sorry. We will see you next week on 19th of March. In fact, the business tax deadline for partnership and S Corp returns is on St. Patrick's Day, and I think that's where I got confused. So nevertheless, with that, we hope to see you next week, where we'll give you some more tips and helpful suggestions on how to maximize the profit of your business on Weekly Profit Talk. So until next week, have an amazing day. And if you have a chance, do something randomly kind for a stranger. So until then, so long. We'll see you soon.